Fellow members of the panel, ladies and gentlemen, good afternoon. It's a pleasure to be here with you today. Given that the title of this, the topic of this summit pertains to manufacturing, I'll stay away from any comments of my personal plans. I can assure you that while my personal circumstances may be going through transition, the perspectives I will share with you remain constant. I think to start with a little bit of cheer and a little bit of good news, I'll go back to the same report that Mr. Sen referred to in his introduction. I think there is a lot to feel good about. There has been this recent survey of the manufacturing sector in India that has shown several positive developments. Given that the manufacturing sector in India is very, very critically dependent on the overall state of economic development, I think we've been fortunate that the last few years have seen sustained and reasonably robust growth in GDP. I think it is based on rather strong fundamentals, and there is a sense that this is truly robust today, given that it is growth that is perceived and visible across a large number of industrial sectors. I think within the overall growth of the economy, one has also seen manufacturing start to grow at a faster tick. If you look at the numbers for the manufacturing sector, they are outpacing the overall economy's growth. And for those of us interested or engaged in this sector, it is further cause for cheer. And this in turn leads to further confidence when one looks at the kind of capex spend that the Indian industry is going through. One has seen tremendous increase in capital expenditures, which in turn truly comes from greater confidence that one has in the country, in the manufacturing sector. And of course, when we look at growth in the manufacturing sector across the world, India definitely belongs to that part of the world or that region where one is seeing increased activity. Of course, we are unable to walk away from any comparison with China, because this is perennial and at these times very important benchmarks for us to keep our eyes on. And indeed, we can see from this chart that while our rate of growth in the manufacturing sector has been encouraging, one always needs to look at the pace that China is setting in these areas. But again, lest we get to be guilty of Michael Porter's accusation that we tend to overstate the positives, I think it's important to bring our feet right back to the ground. These growth rates are happening from rather small base. The base of Indian manufacturing sector, the state at which India's GDP is today in the global context, must bring us back to reality and say that achieving large rates of growth with a small base, while certainly positive, is something that should temper our enthusiasm and our exuberance. India today has a share of GDP, global GDP, that's less than 2%. It's well less than half of China's share of global GDP, and dwarfed by global GDP share of many, many Western countries. So there is still a lot of long way for us to go. And one must look at this over a very long-term perspective. I think when one looks at today India's share of global GDP and global manufacturing output, and when one starts to look at what our aspirations ought to be, it is important to set it in the context that several centuries ago, India and China dominated world manufacturing output. And it is remarkable that in the period between 1800s and 1900, the share of the West in terms of manufacturing output went from a level of about 25% to well over 75% in literally 1 century. So in that context, when one looks at where we are today as India, the share that we have in global manufacturing, and look at aspirations that we ought to set for ourselves as a country, I think we need to keep this sort of historical perspective in mind, and there is no reason why we ought not, for a country of our size and the kind of population that we have, aspire to a much, much larger share of global GDP and global manufacturing output. I will frequently refer to the auto sector, partly because it is a sector that I spend all my time in, and partly because I truly believe it is a valuable and a valid surrogate for the entire spectrum of manufacturing activities in a country. And here too one can't escape the obvious. India's share of the global auto industry is still minuscule. And as much as we celebrate success stories today about our growth, whether it is in the field of two-wheelers, passenger cars, or commercial vehicles, I think here again we're talking about very robust, very encouraging growth, but from a very small base. Now, what do we need to do to make sure that as an industry, as a nation, we're able to advance and grow in size and scale that we believe would be necessary to sustain competitiveness? I think there is no doubt that without a strong, robust domestic market and stable consumption trends, all hopes of growing scale and gaining competitiveness will be difficult. If we take a look at the chart at the lower left-hand corner of this page, the figures don't really matter, but India is the smallest, lowest bar on the extreme left of that graph. And this is really the penetration levels of vehicles in various countries and economies. And it's again a sobering message to realize that penetration of passenger cars in India is poorer than it is in countries like Sri Lanka and Pakistan. So here again, we're talking about a very, very low level of penetration, and in turn, this means the amount of opportunity that exists in this space is enormous. This is validated by the graph on the top right-hand corner, which correlates per capita GDP with vehicle ownership. And when you look again, India is at the bottom left corner of this graph, only indicating that as we continue to achieve broad-based economic development in the country, vehicle ownership and vehicle penetration is bound to grow. And as far as our aspirations, our hopes for GDP growth, the graph on the right lower corner is the graph taken from the now famous BRIC report, which postulates that over the next few decades, India's rate of GDP growth is bound to exceed the rate of GDP growth even for the remaining BRIC countries, Brazil, Russia, and China. So the message is we have a very small base, but as GDP growth continues in India and it is seen to be stable and sustainable over a period of time, manufacturing output, as represented in this case by vehicle output or vehicle penetration, is bound to grow. Now, this is supported by the fundamentals in terms of consumption trends. We've talked about growth in urbanization. India is definitely moving even faster towards urbanization. Whether it is desirable or not may be a different matter, but it seems to be a fairly commonplace occurrence during the economic evolution of countries. But more importantly, to support consumption, the graph on the right shows that even over a period of about 5 years, the rate at which household incomes have grown is very, very encouraging. And this is a fundamental prop to consumption and therefore manufacturing output. There is, this graph indicates that there is visible, significant upward migration of household incomes. And we are at the same time operating in an economy that is continuing to see very good liquidity, very easy availability of money, whether it is at the personal level or at the institutional levels. The low interest rates, very easy availability of financing, have all been very important supports to the growth of the manufacturing sector. I think I should make a point here. I will come back again to referring to the auto industry and the auto market in China. The Indian market has evolved with what one might call a more natural economic model. Most of the passenger car sales here are through private individuals and private owners, and most of this is purchased through access to money through finance and loans. 85%, given that in India 85% of the cars are financed through loans, it indicates a very broad-based natural economic model for buyer behavior. In contrast, in China, 85% of vehicles are sold through cash transactions, and loan availability is extremely poor. Now, this has caused analysts to forecast that the auto sector in India is bound to grow over the next decade quite handsomely, and we crossed a figure of about 1 million units last year. We crossed the 1 million mark last year, and the expectation is that by the end of the decade we should be well past 1.6 million units a year. The fact that we can constantly watch and monitor the kind of progress that China is making and assess where we are and how we're headed is further indicated in this chart. The two pairs of yellow and purple dots show the movement both in India and China over the period between 2002 and as anticipated by 2014. And in a sense, both countries are walking down an inevitable curve in terms of, in this case, vehicle ownership and per capita income. It also seems to indicate that we're lagging China by about 5 to 7 years. And if you look at the Chinese market today, compared to India's automotive passenger car sales of about 1 million units, China is sitting at about 3.5 million units. But beyond the market, beyond the foundations of consumption, one needs a whole lot of other things to achieve manufacturing competitiveness. And I think many of these points have been echoed in the presentation by Professor Anand. Let's take them one by one. This is the result of a fairly detailed analysis commissioned by the Confederation of Indian Industries, CII, to take a look at manufactured products in India and in China and to see their relative cost competitiveness. And the bald answer to this is that there is an advantage in China to the tune of about 23%. Now, if we go back to the sources of disadvantage in India relative to China with respect to these factors, one finds that one comes back to the same set of issues that we have been discussing. So if we take them one by one, human resources, I think it's important that we're here in an academic context, in an academic institution, with a panel with several academics in it. I think it's important that human resources, the availability to trained, skilled resources, is a fundamental building block for manufacturing competitiveness. I think India has boasted of a very healthy education framework, and I think most of us, while we have much to complain about what's good and bad about Indian systems, will inevitably agree that one way or the other, over a long period of time, India seems to have had a fair amount of emphasis on good primary, secondary, and to some extent, university level education. And I think all of us who today comment on the success of various sectors, whether it is the IT sector or other growing sectors, whether it is biotech or manufacturing, will have to no doubt ascribe a fair amount of the success to the availability of good quality education around the country. We have a very large trained pool, perhaps inevitable given the size of our population, good technical skills in that pool. We've had the benefit of commonly used language. English language has been a tremendous advantage to Indian employment, to Indian, Indian industry. And this skill is available at fairly competitive cost. So we have the size, we have the training, and we have the cost competitiveness of the resource pool. But yet, HR policies, labor laws can still add up to sources of or components of disadvantage in this comparison between India and China. And according to this analysis, up to 5.5% of the cost disadvantage between India and China can be attributed in one form or the other to labor laws and labor policy. And while we may, as a democracy, not wish to embrace all of the policies and procedures adopted in China as far as labor is concerned, there is still need to note that